What's up everyone? In this week's video, we are going to talk about the fact that S-REITs would slow down their acquisitions endeavors for this year, presumably. But how will it affect the share prices of real estate investment trusts? So once again, join us for this week's video and then give us a thumbs up and subscribe. So ladies and gentlemen, in my front page Business Times interview last week, I actually mentioned that asset enhancement is actually pretty good for real estate investment trusts rather than aggressive acquisitions. Why? Few pointers that was quoted on Business Times. One, a lack of deals do not necessarily be a bad thing for real estate investors. Why? Simply because in the last couple of years, when real estate investment trusts have been aggressively acquiring assets, right? I mean, real estate investment trust structure is such that if they need to raise money, they are most probably going to go to the market to do an equity preferential issue, which in this case encompasses a secondary issue as well as a private placement. Ladies and gentlemen, the sad news is that in the last 4 years, 25 placements were done. Guess how many placements made money for investors? Very little, which is something that I will share in this week's video. Now, the other quotes that I have said is that AEIs tabled by most S-REITs, have brought better returns for real investors in the long term, as opposed to aggressive acquisitions, especially more at this time now, when it is clear that with rising interest rate environment, as you saw the last time in 2004 to 2006, as well as actually in 2018, you notice that most acquisitions done at that time were actually on thin margins, and surprisingly, and not surprisingly, again this time around, you can see that acquisitions have thinned to a trickle, simply because of this. Let me show you, ladies and gentlemen, some of the 25 placements that were done, in the last 4 years. So this first slide shows 6 placements done in 2020. How many actually lost money for investors? Well, look through all the 6 issues. Yes, with the exception of one, the rest actually lost money for investors. And oh my God, just look, for prime REIT, you have lost 70% of the value. So 100 million raise would have lost 70 million in the course of the last 4 years. The second slide. This shows the placement done in 2021. There are actually 15 placements. Now the first slide shows the first 10 placements. The second slide shows the other 5 placements. Now, once again, ask yourself, how many have destroyed capital for investors? Meaning losing money as of the prices as you see in column 1, 2, 3, 4 as compared to their respective placement prices. Yes, ladies and gentlemen, look at the first slide. 9 out of 10 lost money or capital destruction for investors. Look at the second slide. 4 out of the 5 actually lost money as well. So essentially in the year 2021, out of the 15 placements, 13 lost big money for investors. And the only 2 that's actually in the black based on last Friday prices is actually Reit as well as Capital Integrated and Retail Trust. Now you can see that most of them have lost a lot of money. For example, the likes of Prime REIT, which did the second placement in 2021. You will recall, right? In the earlier slide in 2020, they did the placement in 2020, lost big money, 70%. Even you take the placement in 2021, big time loss, that's 64%. The other one, REIT that lost big money is 49%. That's Capital Oat, Pacific. And then you have actually Manulife, which is down 71%. Oh my goodness. But then again, for GCP Global students as well as you, ladies and gentlemen, has been following us in our YouTube videos all this while, you notice that we have been warning you on US office REITs 5 years before even this current collapse happened. In fact, read my book, I have actually devoted a special chapter to warn Manulife REIT. Before I published it 4 years ago. Yes, ladies and gentlemen, 4 years ago, you can already see the deteriorating fundamentals happening in the REIT if you know where to look. So ladies and gentlemen, the last slide, if anything, is to show you that, or rather, just to take a break, notice that within this slide, United Hampshire is being mentioned, it's down 27%. Now, just last Friday, we hosted a dinner and drinks with the management of the United Hampshire, including Mr. Gerard Yun, the new CEO of United Hampshire. You can see our happy students at GCP Global students. Yes, of course, for regular students of GCP Global, you would be invited and link up with the key REITs, especially REITs that are selling at opportunistic pricing. So, is United Hampshire at the opportunistic level? Well, to find out, do sign up for our class next on the 27th of May. Now, the last slide, ladies and gentlemen, actually shows that the acquisitions have trickled down, materially in the last 2 years. That's 2022, where there were 2 placements done, and in 2023, so far year to date, 2 placements done. Not too bad, you don't have a case where too many REITs have lost money. In fact, the latest one by MLT have actually made some money for investors. So all in all, ladies and gentlemen, looking at all the last 4 slides, the acquisitions by real estate investment trusts in the last 4 years, of which 25 placements were done. So what happened? 3 actually out of 25 made money for investors. The remainder ones, that is excluding the Fraser Centrepoint Trust, which break even for investors, the rest of them have lost big money for investors. So can you just imagine, just take an average size of 100 million being raised in secondary placement, and you are down 20% out of the 17, 18 REITs that have lost money. Practically, 500 billion has been wiped out. So essentially, it's very important, therefore, ladies and gentlemen, to not only exercise AEI, asset enhancement of your body, as well as your physical and mental aspect. How to actually do it? To fortify yourself and strengthen yourself so that you can decipher which are the REITs that will make you good money. Look no further. Let me share with you what we do. Yes, ladies and gentlemen, that is actually our exercise. If you actually do, exercise to actually convolute yourself with the bar, you notice that being able to shift left and right and to know where the shifting sands actually shift for real estate investment trust puts you in a very good ability to walk through the air and be anchored in your analysis, in your understanding of the real estate investment trust, and to strike when the price is right. That's why in our article, our latest, as you can see from GCP Global website, it's free. So do come and see for yourself our last 31 years of detailed research. Investing in REITs, our key point, is about picking the right REITs for your investment portfolio. So once again, if I may just summarize my Business Times interview, front page last week, it is therefore on a comparative basis a better usage of funds, AEI, at this current juncture, with rising interest rate environment, with rising risk. So REITs who actually undertake that, essentially us putting themselves in a better position. So while many of the managers would want to sell you an acquisition strategy, look, sit back, enjoy our videos, and ask yourself introspectively whether indeed these acquisitions, especially when they involve secondary fundraising, involving your money, does lead to capital destruction or capital accretion for your wealth. So in your wealth, we help to protect. That's us, GCP Global. So if you like us, give us a thumbs up and subscribe. Join us for our next class on 27th of May. Once again, until next week. Cheers.